All right, folks, so the way that this is going to work, we've got about 40 minutes. I'm going to deep dive into questions with each of these. If you've been to Best Ever Conference before, we've typically had a catch-ball microphone that you could ask questions. We're not going to do this year because of the sheer size of the event. So after this block of sessions, every speaker is going to be in the ballroom A, or ballroom A, to answer your questions during lunch. So if you have questions that come up with this, take notes and introduce yourself to these gentlemen after the fact. We're going to be talking about 4 different asset classes. Rob Beardsley is here representing multifamily. Jim Fujino is here representing both notes and the future of Aspen Funds, which is syndications. Brian Dietz is here representing in the industrial space, one of the local experts here in Denver. And Chris Bentsen, you guys met him yesterday. He is here representing self-storage. And Chris, I would love to start with you because that is a topic that is very easy for me because I'm also in storage. Chris is with Reliant Management. They're a top 25 owner-operator. They've been doing it for 25 years. You guys have raised hundreds of millions of dollars. You've partnered with groups like Harrison Street. You know what you're doing. My first question for you, when I get to the right part of this email that contains all of these questions, is how did self-storage perform during COVID? And why is the storage space flaunting itself as the darling asset class into 2022? Why do you get the credit for that, Chris?
I don't think I can take any personal credit, but I'd like to. So the worst part of that this morning, and Spence, if you're in the audience, I got to come find you after. He literally said, what's going to happen with operational real estate, and then never answered the question. Like, you're the only guy that I would say, you know, what's going to happen in the future? You probably know what you're talking about. You said, like, operational business, mobile home parks, self-storage, and then you didn't say what was actually going to happen. So I was disappointed by that. But I think the COVID piece is really interesting. I said it yesterday on stage, storage is driven, the demand is driven by transition. So generally when people have transition in their lives, it creates demand for self-storage. And historically, in the last 2 economic cycles, 2007, 8, 9, and COVID, the pandemic, I'm not sure if we're out of it or not yet. But generally, if you have transition in your life, you're going to use self-storage. We use the 4 Ds, death, dislocation, downsizing, and divorce. And I joked about it yesterday, but it's real, right? That's what creates the demand. And so, Ben, to your question of how we performed during COVID, we were one of the darling asset classes. Data centers was up there as well. 2020 for us was fantastic personally and as an asset class. National Association of REIT data showed that self-storage did just over 12% in 2020. Only outperformed by data centers. In 2021, they followed that up with a 55% return. So at the publicly traded REIT level, fantastic. And I know you can speak to it with Spartan, and we can certainly speak to it to Reliant. 2021 for us was probably one of the best revenue growth years we've seen in the history of our company.
Awesome. All right, so 5 years ago, Radius is a data platform in the self-storage space, and Radius would predict sub 1% rent growth. And every year it was double-digit rent growth after that. Maybe there was a year or 2 of stall. Last year, average rents grew by 12%. With inflation, being anywhere from 7 to 20%, according to whoever was talking this morning, what are you expecting for underwriting rent growth in the self-storage space?
So we really haven't changed our underwriting too much on the rental rate growth side. To your point, we saw a lot of markets with double-digit rent growth, which is insane, right? In self-storage, it just doesn't happen. And so for us, what we are sticking with is generally we're outpacing inflation a little bit. For us, we're still sticking kind of in that 4.5% rental rate growth. And so for storage, 4.5%, you pay $100 a month in a unit, we're adding $4.50 a month, $50 a year. So relatively, it's a small dollar amount. Ben, I think the interesting part, you talk about Radius, it's hard to predict the future, right? I mean, they literally said storage is all done, there's too much supply, we're going to go into a market where there is no more demand to fulfill supply and we're all going to go under. Whoops. I mean, it's hard to understand what really is going to happen until you're in it, and I think that's the critical part of finding great partners who can be dynamic in the marketplace as different situations arise.
What about cap rates? Thank you for the rent growth conversation. What about cap rates? You mentioned yesterday they compressed, no, I'm sorry, it was Ryan that mentioned they compressed 85 basis points in a 6-month period, which I'm pretty sure is like a record for any asset class. I haven't been around long enough, but at least in 10 years, which is the entire history of commercial real estate, I think that's a record cap rate compression. for anything. Are we expecting more compression, expansion as a result of interest rates? What's your crystal ball, Chris? I'm going to hold you to
I
it.
have no idea. Listen, and here's what we do, and I think all of us probably approach it the same way, is we underwrite it's going to get worse, right? So each year we hold the property, we're saying values are going to go down. Now, has that happened in the last 5 years? Nope. Have our investors benefited from it? Sure have. But for us to say what we think is going to happen 6 years from now and make a projection on exit cap rates is silly. It's a fool's errand. None of us, and there's some smart operators in the room who've had a lot of success. Nobody knows. So we make an assumption that things are going to get worse, and we hope it's worse. We have assumed it's worse enough. And what I would say, my personal interpretation is there's a lot of experts you should reach out to. Spence, if you guys weren't impressed with what he was presenting on stage, man, that's powerful data that guy has access to. And it's incredible. And Spence will tell you 2 out of 3 ain't bad, right? He's not going to be right on everything. And he studies it far more than any of us can dedicate time to. So for me, what I believe with cap rates is in the short term, I think cap rates stay generally where we are. Because there's so much capital in the market. Until that cycles through, it's hard for me to understand how we see cap rate expansion. But interest rates are going to go up. There's going to be some volatility there. After 18 months, looking at me and asking what's happening with cap rates is silly. I'm not going to be able to tell you with any sort of accuracy whether they're going to go up or go down.
All right, fair enough. I would say the same thing if I was sitting in your seat. All right, before we move on, I have a question for the audience. Who here has ever made an investment into industrial, passive or active? All right, so a couple, but not enough that I'm not going to ask this softball question. Brian, you were the VP of Investments at Prologis, which I believe is the largest industrial owner on the planet?
By far.
By far. Okay, thank you for verifying that. But now you are launching the industrial platform for Evergreen, which is based here in Denver.
Correct.
And my understanding from talking to others, I hope you don't mind me classifying you as such, you are a bit of a industrial authority in the western half of the United States, if not the full U.S. So thank you for being here. Sorry to ask you such a remedial question, but can you start us off with explaining what exactly counts as industrial, and what are the major forces that influence what industrial is or what the play is?
Yeah, well, in simple terms, it's really any real estate that's built on an industrial zone piece of property. However, most of what we see is warehousing. And I wouldn't think of warehousing particularly as warehousing of consumer goods. That's a significant portion of the industry. But I would think of warehousing as like a blank canvas, meaning developers often build speculative concrete boxes, and then what happens inside the box is up to the user. And there's a myriad of things that happen inside those boxes. Of course, there's warehousing and distribution of consumer goods, which is probably the most common use. E-commerce falls into that same bucket. Home building, light manufacturing, food and beverage, technology, aerospace. So the buildings themselves tend to look pretty similar, but what happens inside them is very diverse.
What happens inside them? And what are you investing mostly as a representative of Evergreen in development, or are you taking those shells, owning them, finding the tenant base, and then building them out with the TI?
Yeah, so we are a ground-up developer, and we'll do what's right for each investment, although typically we look like a merchant builder. So we build a building speculatively, put tenants in there, and sell it to an investor.
When I hear of speculation in anything, I have like the little fuzzy like, uh-oh, if I don't know what I'm doing, I probably should be not doing this. But, I mean, how has speculative industrial development performed? I mean, has it been like multifamily the last 8 years, where, like Chris said yesterday, it's been very difficult not to make money? Or are there losers in the industrial spec development game?
It's been very good for the last few years. COVID only exacerbated that because there became this much greater need for warehouse space. Cap rate compression has done a lot to keep the market lively. There are many groups in lots of cities that are putting up buildings and selling them vacant. Or even selling them...
Successfully?
Yes.
Okay.
Or even selling them off the brochure as a forward commitment. So you own it when it's done. That's how great the capital demand is for industrial right now.
Okay, so when I think of industrial, my simple-minded brain, not knowing industrial, just thinks, oh yeah, that one asset class that Amazon consumes everything of. Is that true, or like who are the users of industrial? Do you have to know somebody at Amazon to be successful in that space, or is it still fragmented where you could get into this game if you have some level of commercial real estate investing chops and you're coming from another asset class?
Yeah, that's a good question. In 2020, it was far and away Amazon. Amazon leased something like 50% of all the new space built in the United States in 2020, which is just an insane statistic. They've really slowed down. I think they're kind of taking a step back and thinking about what they want to do next. They mostly lease their assets, and they're starting to look like they want to own them. I figure as it relates to e-commerce, someone's going to challenge them. Capitalism just doesn't work where there's one group and no one else comes in to challenge them. Walmart's going to get their game together eventually. Target, there's a lot of direct consumer e-commerce happening. Like Nike's a great example, and Vans. I'm wearing Vans. I designed these online, and they got shipped to my house direct from Vans.
All right, so you're cool.
Probably some, but probably
I thought I had cool oyster socks, whatever.
It probably got built by a robot, right, in some warehouse, and I think you're gonna start to see more and more of that. And then the supply chain, we were talking about this backstage a second ago. 15 years ago, users of warehouses were trying to do just-in-time logistics, right? Like try not to keep product or pieces of your product that you're manufacturing in warehouses for very long because it's expensive. And what they've now discovered is that when you get a pinch in the supply chain, which is happening now, then what do? You have nothing. So there's a lot of groups now rethinking how much warehouse space do they need because they probably want to store more than they used to.
Okay, awesome. I've got one more question for you before we move on to you, Jim. You're on deck. I know you're coming from an industrial mindset, so translating that here to this syndicator space where we don't play at like the tiny level, but we're kind of playing in that mid-market level. To better understand, if I were to hand you $100 million today, don't worry about your cost of capital, it's on par with everybody else, what would be your unique play to not bump up against the Prologis, the Evergreen, in today's environment, in the start of 2022?
Well, I don't think this is unique, and it goes against the question you asked, but I think the best place to place capital right now in industrial is in higher rent growth markets. And you're going to bump right up against groups like Prologis. But with the rapid increase in construction pricing, the markets that have the best rent growth are doing the best. Phoenix is a great example. I think 2020 to 2021, so a 24-month period, like beginning of 2020 to the end of 2021, rent growth in Phoenix was 23%. And Denver, it was like 5%. So you got to go put your money where the strongest rent growth is.
All right, so let's drill into that though, because Prologis, are they going to buy every single industrial building in Phoenix, or are they going to buy just the big stuff, but there's still a need for the small last mile stuff? Like,
yeah, and the second part of what I was going to say is there is a need for smaller industrial that most developers are not building right now. There's great demand for it. The reason why they're not building it is because the amount of effort taken by the people sitting in the office is the same if you build a 50,000 square foot building as if you built a 500,000 square foot building. So why go make $1 million over here when you can make 10 million over there? And so as a result, smaller industrial for users to own or to lease is hard to find. So there's definitely a need for that. And then in terms of Prologis specifically, I mean, they've been so successful because they're really careful how they place their money. And in this sort of hyper-competitive environment, I think there are groups that are willing to be a lot more aggressive than they are in general.
Okay, awesome. Thank you for that. Last question, 10 seconds. Still primary if you were to go build on spec small industrial? Or would you go secondary, outer suburbs of primary, like a Longmont to Denver?
Yeah, I'm wearing a really different hat now. I've been at Evergreen since November. So that's actually freed me up. It's a small entrepreneurial organization, so it's freed me up to look in lots of different places versus working for a big institution like Prologis, where they're really focused on the handful of institutional style submarkets in each city.
Okay, awesome. Thank you for that rundown. For a lot of us, this is probably an early exposure, first time exposure to industrial, so thank you for being here. Jim, you've been in the game across multiple asset classes for a good spell. You've seen a lot. And you took advantage of a very niche opportunity when you started Aspen Funds with Bob Frazier. Was it 9-10 years ago? Right after the GFC, you launched a fund that would buy non-performing second position notes on performing firsts. And that game was really good to you. It lasted a lot longer than you expected. Is that game still alive today? Or is there still distressed debt?
Yeah, first of all, though, I have to say, I bought these shoes right off the rack retail. I don't think they ever saw a warehouse, and they fit perfectly. So this is like, I didn't know this was going to be a morbid panel, but I mean, seriously, Chris? I mean, death, divorce, disease, destruction. This is when things are good. Times are good for.
That's what we're all about.
That's how storage thrives. Yeah, and the good times too, though, right?
I'm just fun, and I mean, yeah. So I entered into the distressed debt. There's another D, a distressed debt space, and we. Really, it was born out of need for me because I had been a developer in Southern California, small infill residential development. Got my butt handed to me twice, pretty significantly, because of the financing involved in real estate. And so I was looking for something to do at 55 years old, broke with 5 teenagers, and went to a conference actually in Denver on distressed debt because I didn't want to just buy REOs and do flips and short sales like everybody else was. So I said, where's the opportunity besides everywhere at that point? And so went a little further upstream and looked at like, well, gosh, these institutions are hemorrhaging toxic assets. Remember that terminology? So I started like retooling my brain towards the debt side of the equation rather than the equity side, and then I found a little side room where some guys were talking about buying second mortgages, which sounds like insanity. You already have non-performing mortgages in general, and you're buying the non-performing like HELOCs and the seconds. Like, why would you do that? And I won't take a lot of time to explain why, but basically, in that second position, the leverage that you have on the equity and the property. That sounds pretty morbid too, I guess, now that I think of it. But it's like having a call option on the equity in the real estate that not only doesn't expire, but actually gets more valuable with time because in general, everybody knew at some point the real estate values were going to start increasing. And these, by the way, most of these cases, the vast majority, these borrowers are still paying on the senior mortgage. So they're paying down the principal on the senior, which pulls us further down into the capital stack. We're continuing to accrue interest, which makes our call option more valuable over time. And the real estate's going up, so the equity's climbing. So honestly, when I partnered with Bob, I explained this model to Bob Frazier on the back of a napkin in 2012, but he's a lot smarter than me. I think I'm better looking, but he's a lot smarter. And he saw this and says, oh my goodness, we got to scale this. And I'm thinking, I think it's only like a 2 or 3 year opportunity because it's such a niche, you know. And but what we did was we built a team of just the most fantastic people in the world. We have our own in-house workout people that were kind of former loss mitigation people, bankers. We even have some attorneys that didn't really like practicing law, but they contact these borrowers, and I mean, they're really good to these people. We're very compliance-minded. We have hearts. We care about people, and we produce win-win-win results, 75% of the time, which means we end up modifying the second mortgage. And mind you, these people, these borrowers, in a lot of cases, haven't heard from anybody in as much as 10 years. They haven't made a payment on it. So the first thing was we have to wake them up and say, no, you really do still owe this. You don't necessarily owe it, but your property owes it. So we're able to modify these mortgages and or settle at a deep discount because of the discounts we buy them at. Now, in the last 2 to 3 years, the margins have tightened because there's so much equity in the market now that most of these are way lower risk for us to manage the process. So again, what I thought was going to be 2 or 3 years has turned into, like we've been at it 9 years now. The deal flow has always been lumpy. There's no big box store or place where you can go find pools of non-performing second mortgages. And a lot of these will never see the light of day because the institutions have already charged them off and they just don't want the political drama of having some, cowboy entrepreneurs calling borrowers when their name's on the paper chain, you know what I mean? So we have, the other side of our business is we actually have an income side where we buy reperforming and performing residential paper, and we buy it typically at a pretty good discount. So we're buying at a yield on our investment in the low double digits, so maybe 10 or 11, 12% on what we paid for the mortgage. But since we're buying it at a discount, when those mortgages pay off, we recover this windfall. And right now, that's been, so I'll be morbid too, because you're probably going to ask me about COVID. Honestly, we've had our record-breaking growth quarters.
In notes?
Yes.
Okay.
Almost from, and I can't say it's not pegged to COVID. It really more pegged to the real estate market recovery and the continued appreciation of property values. So it's been really good to us. We have fantastic processes and team in place, and we're going to keep doing that forever. But now we're expanding into some other verticals, which I won't get ahead of your questions.
Yeah. I want to circle back on the other verticals. To stick on the notes for now, is there distress? With COVID, we were all kind of waiting for everything to drop. And I know that you primarily invested in the single-family rentals, but I know you pay attention to debt in general. Mm-hmm. Has opportunity for distressed debt come about, or has it decreased over time despite COVID?
It's really kind of fascinating because really, if you look at, and all the statistics are available at FDIC.gov, you can find a lot of data, but definitely the mortgage crisis, you had this, just everything was distress. So you had a lot of opportunists like myself that jumped into that world because of this anomaly in what is otherwise a pretty steady state deal. Even at the top of the crisis in the mortgage world, my partner Bob was telling me that the foreclosure rate was like 5%. That's not that big of a deal. The delinquency rates are even less than that. So we saw, a year ago when COVID started, we saw a spike in again, this data is available. We saw a spike in what they call seriously delinquent residential mortgage world, but in the last months, it spiked back down. So all of the people that didn't continue paying their mortgages during COVID, besides a small percentage, either they worked out forbearance agreements with their senior lenders, or they took all this money that was being given to them and decided, you know what? Life is good. I have equity in my house again. I really didn't lose my job during this. I think I'll just, get over COVID and pay my bills and move on with life. So there is not this big predicted incredible distressed debt opportunity again. So the bottom line is there's always a pretty good amount of distressed debt. And so we've moved from being an opportunistic, we exploited an opportunity, based on the D's, and now we're like perennial players in this space. So there's always mortgages that are in default or in a delinquent state. So again, margins get tighter. It's not as fun as it was, 5 years ago, and the regulations are higher. So it's a lot more of it's a more mature, sophisticated space to try to play in now. And we're small in the residential debt world. In the seconds world, we're pretty big and we're well known, have a great reputation. But in the world of distressed debt in general, we're tiny, and we intend to do something about that tininess.
All right, awesome. I want to circle back with you to talk about your new verticals. In the meantime, Rob, you started off 5 years ago with Lone Star Capital as a result of the Best Ever Conference, which, again, I'm just going to go ahead and brag about that. So thank you for being a story of success. I think you've got the best age to assets under management ratio in the world, and you are very smart. You put out a lot of content, a lot of economic focus and underwriting focus on your content. As our multifamily representative, where's my question here? Can you walk us through the story arc of the economic impact to multifamily from COVID? What's happened over the last 2 years to multifamily? I think everybody was expecting not great things to happen with forbearance and all that stuff, but what actually did happen?
Right, so as Jim said, we were all predicting this massive downfall, great opportunity. We're gonna sit back and be patient and wait for these discounts, and those discounts never came. I remember getting the calls that said, you know what, I'm waiting for the COVID discount. Is it a 5% discount, 10% discount, 20%? We were all arguing what the COVID discount was going to be, and it was nothing. It never happened, and because a lot of the players in the space had this mindset, it completely stifled transaction volume in 2020, right at the onset of COVID in March. So that's talking about the transaction side, and then obviously on the operations side, there was a great deal of uncertainty. Are tenants going to pay rent? There, depending on what markets you were in, there was discussion about, the political climate about not wanting to pay rent. So there was winners and losers from an operational standpoint. COVID exacerbated the long-ranging trends of migration from urban to suburban, to the flight to affordability, more quality of life markets. So the winners just became bigger winners, and the losers got hurt even further. And then, however, we realized that it wasn't as big of a crisis. And then the money started coming, right? Rent relief checks, everyone's getting rich, rents are coming in from the government, tenants are paying also, we were getting record collection months. So it was really a bonanza. And then once the coast was clear and everyone was seeing that things were fine, then the transaction volume kicked off. And really with 2021, it was a banner year. I don't have the numbers, but it was maybe one of the biggest transaction volume years for multifamily ever, just because everyone who was waiting for the COVID discounts in 2020 didn't get a deal, and we all live off deals. We're all deal junkies. So in 2021, we all came back. We had all this money on the sidelines, and it just poured in. So as we talked about cap rate compression, cap rates certainly had to have compressed around 85 basis points in multifamily as well. And we're seeing them now in the low threes for the major growth markets.
Okay, so you're in the low threes for your cap rates. Your rent growth last year was what?
Depending on where you are, it wasn't hard to see double-digit rent growth.
Okay, so double-digit rent growth, cap rate compression in an asset class that people started saying in 2016 this stuff is overpriced. That's what you're saying?
That's exactly right.
Sweet.
20 to 50%.
Okay, so are we at a wall now? Have we hit return parity with real estate compared to other alternative asset classes, or is it just going to keep climbing ridiculously to the end of time?
So the other part about COVID is it wiped out two very large, important real estate asset classes, office and hospitality. All the capital in the world said, we don't like those, we're going to go elsewhere. And where did they go? They went to storage, industrial, and multi. And those were the darlings, and they performed very well, not just from an operational perspective, but also from a capital demand perspective, right? Cap rates are influenced by interest rates, but even more overwhelmingly influenced by where the money wants to be. And money wants to be in multifamily. And so that's why cap rates are low, even as interest rates are rising. So I think we're at a really interesting inflection point now where the Fed has given us some rope. We've enjoyed low interest rates, and they even went lower as a result of COVID, which did nothing but increase prices further. But now they are going up. And I think the increase in interest rates, as some people predict, is going to push cap rates up, but it's never that simple. You have two factors that could keep cap rates low in spite of rising interest rates, and that's number one, lender spreads coming in, right? At the end of the day, we're real estate borrowers, right? We're equity, and the debt we borrow is based on interest rates, the index rate, plus a lender spread. And the spread is how lenders make their money, and spreads are now a little bit wider because the indexes have been so low. So lenders have been getting away with a little bit more profit, but I think lenders are going to reel in their profit to allow for transactions to continue. And the other thing is the rent growth. There's a good 18 months left of this big inflationary rent growth that has to work through the system, and that's going to keep cap rates low because people are buying in low on the expectation that growth is going to get them where they need to be.
Okay, so my question was going to be about stabilizing cap rates versus continuing to compress, but I feel like I've got a little bit of an early answer because I talked to the capital markets panel that presents tomorrow, and I'm going to keep you all in the dark until then. See you in the morning. With that said, Brian, I want to float back to you. There's not a lot of industrial syndicators out there. This syndication space is not new, but it's really burgeoned in the last decade. And with all the presentations and things that you're saying, industrial is exciting to the passive investors out here, and we are starting to see some syndicators in industrial. So as they start to come about, I know I didn't prep you with this question, so I apologize. What are three red flags that can help distinguish fly-by-night kind of industrial spec developers from people who know what they're doing?
That's a great question. I think paying attention to how they're feeding you the market data, meaning industrial is a really efficient product class. especially when it comes to the more logistics style buildings, like big cross-dock warehouses like what Prologis owns for the most part. It's like the most commoditized form of real estate. So it's very efficient. And so making sure that the investment you're looking at isn't overstating rent growth, has the rents that they've put into their pro formas backed up by actual market data and significant market data, not just cherry picking the few best deals that happened. And I think that that same thing happens on the backside with cap rates and price per pound when you're selling an asset. Does that answer your question?
It does, though I do want to get more specific.
Yeah.
And I'm going to ask you what that rent growth ridiculous number is, and you're going to say it depends on the market. So take away the 5 best markets. What would be a ceiling for acceptable rent growth from your intuition, being in the space?
Save from the really high rent growth markets. I think most markets are predicting kind of 5 to 7% in the next couple years.
Per year, correct? So accumulating 5 to 7% per year.
Yes, yeah. What most groups do is they underwrite a pop in the next 2 or 3 years, and then they normalize it down to 3%, going out into the future. Okay. I think if possible, if a group, and this is what we do, if a group is underwriting today's rents with cost inflation and their deal works, it should work.
Okay, that's a great point, because we're all talking about rent growth and cap rates, but inflation impacts expenses just like it impacts your revenue. What is an appropriate cost basis, excluding property taxes and insurance, because those are 2 different kind of drivers, but what is underwritten inflation on your operating expenses in industrial?
Oh, on operating expenses?
Yeah.
I deal mostly in ground up merchant build kind of developments, so I don't look that closely at that. Okay. I don't have a great answer for you. In my past, when I have had those kinds of roles, it's just 3%. You underwrite 3%. I can't imagine that the long-term holders like Prologis are doing that right now. They've got to be underwriting some growth in operating expenses.
5, 6, 7. Yeah.
But it's a triple net, asset class.
So it passes on to the tenant. Yeah.
It passes on to the tenant.
Sure.
They're, when it's a tenant favorable market, tenants will negotiate in caps in their growth of their expenses, but typically it's mostly passed through.
Okay, so that might be the answer to my last question for you, which is around how inflation impacts the potential of industrial relative to other asset classes. My intuition is the shorter your lease time frame, the better hedge against inflation you have, storage being a month, multifamily being a year, industrial being 3, 5, 7 years. So how is the industry prepared for inflation in building out its long-term contracts? Is it underwritten already in the contract terms?
So typically the leases have interterm bumps, like annual bumps. And as the landlords have gotten more leverage the last few years, those bumps have increased. In a market like Phoenix is a good example. It's probably 3.5, maybe even 4% right now, which is less than inflation. So, when these groups are underwriting like a 10-year DCF, they've got big pops.
DCF being discounted cash flow analysis?
Correct.
Yep.
They have big pops when those leases roll.
Okay. Okay. Thank you, Brian. Thank you for being here. Chris, I want to move on back to you.
Can I ask Brian a quick question?
Oh, yeah. Please do, Chris.
So Spence had an interesting stat today about the internet penetration of goods. Were you here when he was here?
No.
So basically, he showed a graph where it showed essentially internet penetration of goods has been doing this, right? So e-commerce, everything's been growing like crazy. But in the last, I don't remember how many quarters, it's flatlined. I assume there's a bucket of goods that he's looking at there. Does that give you pause at all? That's what his point was, is industrial should be thoughtful of what's happening, right? Which, thought process is less e-commerce, maybe less demand for industrial, a lot of development right now. Do you think about that? I mean, and how that impacts the asset class?
Yeah, there's 2 schools of thought. A lot of groups are saying there's still a lot of runway for the expansion of e-commerce. Maybe we've only hit 20% or something of the total growth in that segment. But on the other side, the retailers that are shifting from selling things in stores to selling things out of warehouses, they're not making money off of e-commerce. It's costing them money.
Yep.
And so that has to be reconciled in some way, or else that's going to slow down that growth.
Sorry, Ben.
No, you're great. Thank you for asking that question. I do want to ask you another question about migration patterns, though, and I'm going to come to you with the same question, Rob. So self-storage, multifamily, I mean, all asset classes are following migration patterns, but I'm curious about both of your takes. How is migration patterns changing the way that Reliant is looking at opportunities going into 2022?
So it's a fair question. I mean, what's interesting about storage is we operate primarily in the Southeast, so Florida, Georgia, Carolinas, Alabama, Tennessee. And historically, in the last 10 years, we've benefited from that net population migration, mostly out of the Northeast into the Southeast. But what's interesting about storage is it's a very sharpshooter's game. It's a micro market that we look at. I mean, when you think about storage, right? No one's going to drive for amenities at a storage facility, right? We don't have good school districts. We don't have pools and gyms. We have a box, and some of our boxes are heated and air conditioned, and some of them are not. So it's either got to be convenient to work and school, or work or home for you to basically be part of our addressable neighborhood. So we really focus, Ben, and I know you guys do too, on, we used to do 1, 3, and 5 mile radius around the facility. We've started to go to drive times, like how long does it actually take me to drive to the facility? So when we think of population migration, generally we'd like to be in a market where there are more people coming in than leaving. That being said, when you're looking at the lens of the market through a peephole, and you're just looking at this one little spot, there's all these interesting little things that happen in a market that create a lot of demand, even in things in a market that may generally be losing people, right? Military bases, college campuses, a specific employer. Those kinds of things are what make it fun to underwrite deals. And really, our underwriting team talks about building a story around a market, right? It's not just looking at the statistic that everybody can see and say, look, we've had 22% population growth in the last 10 years. It's about understanding what are the things happening in that addressable market, and can we take advantage of them? And Ben, you know this, but for the audience that isn't as sophisticated on the self-storage side, there's no real metric that measures self-storage demand, right? There's some made-up metrics. Everybody wants to talk about square feet per person. The science behind that is really sketchy. But one of the great ones is look at the comp set, right? If you're looking at that 10-mile radius or 5-mile radius or 3-mile radius, depending on the market, if everybody's full, generally demand's pretty good. If everybody's at 75% and there's 3 new facilities that are half full, probably don't want to be there. So, it hasn't changed. We're not saying we don't want to be in these specific markets because of that reason. We want to look at, tell me the story of this market, and if there's not a great story for it, we don't want to be there. But it's more so than just a statistic of, hey, what's population growth been in the last 5 years?
Awesome, thank you for that. Rob, similar question. Spence was saying this morning that without immigration, we actually have a decline. We're Japan. We have a declining population. So where the heck is all of this renter demand coming from? I don't understand how the Saul Urban Group can convert all of these hotels for affordable housing, and that all of this renter demand can still be there to drive up rent growth, to drive up new construction and conversions for housing. Are you looking at migration patterns? Are you looking at the reduction of the average people per household? Like what are you looking at to understand where the demand is coming from? And then Jim, I'm going to let you take it home.
Yeah, it's all those things. It's things that many of us in this room know about and talk about as the driving forces of this long-ranging demand that multifamily has. Just to go over it, right, we have the delay in family formation, the reduction in people per household. People are less wealthy, so they're buying homes less, and there's more of a rent. We're becoming Europe, where Europe was ahead of us by about 20 years as far as being a nation or a group of renters, and that's where we are headed. I think our homeownership percentage peaked right before the great financial crisis at about 63%. And I think we're just headed down in a secular fashion.
What's the most impactful metric of the ones that you just mentioned? Is it migration patterns? Is it the reduction of heads per household, delayed family creation, income inequality, driving down wealth amongst the major components? Like, what's the most important factor?
It would have to be migration and immigration, because that's not just people being dispersed evenly across the country. There's winners and losers. Right, people are going to the affordable low cost of living parts of the country, the Sun Belt, Texas, Southeast, and those have been the real big winners that were already winners pre-COVID, and then COVID exacerbated those trends as people wanted to work from home, get a better quality of life, and not be stuck in a cramped city.
Awesome, thank you, Rob. Jim, to bring us home, Notes just hasn't had enough opportunity for Aspen Funds to grow the way that you wanted to grow. Where is Aspen Funds heading to into 2022? Where is your focus set?
Right. So again, so we have wait lists for our distressed debt funds. We are actually, we're going to stay in that space. We really have a separate company in a sense that we're in distressed debt till there's no longer distressed debt, which basically means to the end of time, right? So, but we are going to be moving into the first lien world, kind of coming from a different perspective on that. But what we've always believed is what we want to be is, and what we are, is we're an alternative investment provider, and I'll say educator, to the retail investor world. And then we're a capital provider to people in these various verticals that make sense to us for people that need a little extra equity in their deal. So, we're always learning. We're macroeconomics minded. My partner Bob Fraser, he's going to be on the panel this afternoon. You'll hear him talk about that. He actually does an economic report that we put on our website. We have some brilliant people on our team, leadership team, myself excluded. I'm experienced. I'm not brilliant, but so we look at the macroeconomic trends, and then we say, okay, we like within that, there's inflation. So yeah, we believe multifamily is a great play. Not necessarily every geography, but we're not going to go try to be the multifamily players. So where Aspen Funds is going is we're going to find. So the track to run on is multifamily. The horse to ride is, let's say, a particular geography, but then the jockey. So we're looking for jockeys. We are looking to deploy our investors' capital, and they trust us because we got some of the, it's kind of the old farmer's deal. We know a thing or two because we've seen a thing or two. And then we find the best players, best-in-class players, and not necessarily the best, but they're high quality that still need our level of capital. Because there's guys up here that they don't need us. They don't need what we bring. But we can help people get to where the big boys are. And we love doing that because it's kind of a mentorship model as well. So we come alongside of companies and we co-invest with them. So we will always be in the distressed debt world. But the deal flow has been lumpy, but when it opens up, it's really easy for us to raise capital to get into our distressed funds.
I know, I'm on your wait list.
Thank you for saying that.
Awesome. Rob, Jim, Brian, Chris, you're all great. Give these gentlemen a round of applause, please, and thank you. Thank you very much for being here. Really appreciate y'all. They will be available in the Q&A room at lunch break, right behind us, Aurora Ballroom A. Thank you, gentlemen.